Hello, everybody. Welcome to our fall webinar series. My name is Merlin Rothfeld of the Online Trading Academy. Hope you are all having a great day, a great evening out there. Today, we're going to talk about what is happening in our economy. For many people, you might be extremely optimistic about what's going on in our economy. Others of you might be extremely pessimistic and wondering when the sky is just going to fall apart and everything just goes to hell in a handbasket. Well, hopefully our discussion today will shed some light on that topic and give a little more clarity as to what's impacting our markets and where we may be headed. Joining me today, we've got none other than Larry Jacobson, and we also have Bill Addiss joining us. So you guys might know them from the Online Trading Academy stable of instructors. So gentlemen, glad to have you with us for this discussion. How you guys doing?
Great to be here, Molo.
Pleasure to be here. Thanks for the invite.
I wouldn't have it any other way. I'm excited to have you guys with us. So I'm going to start this off before we get into kind of our four major areas that we're going to discuss. And by the way, for those of you, this is interactive. Feel free to ask questions along the way. We'll probably divert most of those till the end unless it's specific for some of the actionable charts. But I wanted to go into a bigger picture. I want to kind of set the stage because we're all experiencing something that we really have never experienced before. And that is a different type of economy at this moment. We are looking at what's really the COVID-19 economy. And of course, this virus has done a wonderful job at putting a damper on business, on our economy, and many other things. So we know that it's damaged the economy, but to what extent, I think we are still discovering. What I wanted to do just to set the stage is show this chart. Because much of what we have done in reaction to COVID with our Fed, our government, all this interest rates has been due to that sharp acceleration you see on the left-hand side of your screen, where we had just a parabolic move in COVID cases. Now you can see that it's been, luckily for us, slowly drifting down. And if this gets back to some semblance of normality, then all of a sudden, all the stimulus and everything could have a much more significant impact on our market. So to me, that's the big umbrella here that is overshadowing the entire economy is COVID. Now, from that, we will look at four major things for today. Number one, we're going to talk about the Fed because they are the one who's backstopping this market and doing anything in their power to keep the markets going up. As you guys heard today with Jerome Powell saying we're keeping rates right where they are for another 3 years. Good luck with that one. Number two on this is going to be interest rates and bonds. And luckily, we've got some bond experts in the room. Number three is going to be talking about the government and what they have done to promote and push this market higher. And finally, we'll do a real quick look at some of the economic metrics, some of the things you're familiar with, like GDP, retail sales, some housing data as well, to give us a little more clarity as to what is actually happening as a result of the Fed, interest rates and bonds, and government. So with that, I'm going to go back to our panel here. We got a short panel of three of us today. We've got Larry Jacobson and Bill Addiss. Bill, I'm going to start the Fed off with you since I know you actually teach some classes for the Fed. So I don't know if we could get a greater insider than you. So start me off with the Fed picture on our economy.
Absolutely. And thanks for the opportunity here, Merlin. The thing I need to stress to the audience that we're talking to here is what our Fed is doing in this crisis is literally unprecedented. It's unprecedented in terms of size, the amount of intervention they're doing, the scope, the variety of assets that they're buying. And the Fed has literally given themselves an unlimited checkbook. So what we need to talk about, though, to get into the weeds just a little bit, is to explain the Fed's balance sheet. So the Fed is a corporation. I need to stress right up front, the Fed is not a part of the government. That's a common misconception. The Fed is a corporation, and it has a balance sheet, assets just like any other business. Now, the chart you're looking at here, all right, the gray line in this chart is showing you what the balance sheet of the Fed looks like. So if we go back to 2011, what you see is, what we're correlating here is the growth of the S&P to the Fed's balance sheet. What we're going to show you is an amazing correlation between what the Fed is doing about putting liquidity into the market and the response that we're seeing from the equity market. You know, one of the questions I get in a lot of my classes is, if the economy is doing so poorly, why is the stock market hitting record highs? And I think it's a great question. And one of the answers is what we're going to explain here. So at a broad outlay, this chart we're showing you is the correlation between the Fed's balance sheet, which I'll explain in a moment, and the S&P. But if you could jump forward to the next slide, I think we can make the Fed balance sheet argument a little bit easier. Good. So the Fed, as I mentioned, is a corporation. And like any other corporation, they have retained earnings in the business. Now, before the economic crisis of 2008, the Fed had approximately $1 trillion of assets on their books. Then the Fed decided to start quantitative easing. That's what we're doing again now. That's the key buzzword here. And under quantitative easing, what our Fed does is they literally create money. They print up money to buy assets. That is the element of quantitative easing. So in 2008, the Fed printed up $800 billion of new cash. Literally with a push of a button, they created $800 billion. And with that money, they went out and bought treasury bonds. The goal being to put more cash into the US economy and take bonds out, that would drive interest rates lower. So the Fed printed up, created $800 billion back in '08. Then you can see by this chart in 2011, the Fed increased their balance sheet again by printing up more money. They printed up another $600 billion, bought another $600 billion worth of bonds. Along comes 2012, the Fed printed more money. So ultimately, if you look at last financial crisis we had of '08 through 2010, thank you, great illustration. That was quantitative easing round 3 that you just highlighted there. But if you look at quantitative easing 1, 2, and 3, over a 4-year period, our Fed put about $3.2 trillion of cash into the US economy. And many people feel that that was certainly a help getting out of the economic crisis. Well, if we move forward to today, all right, in March of this year, this is the critical point. When the pandemic crisis hit, our Fed took intervention that we have never seen before. And that's illustrated by the right side of this column. Because if you look and see for 2020, look at what's happened to the Fed's balance sheet. If you would go back one more slide, if you would, I went ahead, or even this is better, I'm sorry, this is whichever one. But if you look at 2020, all right, our Fed has increased their balance sheet by $3.4 trillion in 3 months. In other words, our Fed has now done more intervention into the market than in the 3-month period than they did during the entire financial crisis of 2008 and to 2012. Literally, Chairman Powell of the Fed has given themselves literally an unlimited checkbook, because under quantitative easing 1, 2, and 3, we knew how much they were going to do. They gave us a specific amount. In March of this year, what our Fed said is we're going to do is what is ever necessary, meaning we'll give ourselves an unlimited checkbook. So the Fed has, at this point, interceded to a degree greater than we've ever seen. And the other thing that we don't really have time to talk about, but I'll mention briefly, in today's world, when the Fed is out there buying assets under quantitative easing, they're now buying corporate bonds, they're buying junk bonds, they're buying municipal bonds. In other words, back in the old days of 2008 through 10, the Fed only bought treasuries and mortgages. Now the Fed is out there buying a basket of different securities, and this is having real ramifications to a number of different market sectors. But I don't want to manipulate or monopolize the conversation. I could talk about the Fed for hours, so I'm going to shut up.
It's good. I love it because there's a couple of things I want to bring up. Number one, guys, when you look at that chart that Bill had talked about earlier, you can go back and you're looking at a 5-year period of time where they injected $3.2 trillion in the economy. And you could make the argument that that was too much. You can make the argument that it was too little. As a test at the time, it seemed like it was way too much money. Now it seems a little bit more reasonable, right? Like it wasn't that bad. So
hindsight is 2020.
It is, right? And the system, and when we did that, there was this belief that we're going to get hyperinflation out of it. If we don't do this, everything systemically falls apart. And when we look at the numbers, just the data that I'm going to show you here in a little bit, going back into 2008, it was chump change compared to the impact of what COVID has had since February. And the charts are just speak for themselves. So it's interesting to see that they put in $3.2 trillion and it over 5 years. And all of a sudden they put in 3.5 or 3.4 in 8 months. And so all of a sudden we still may get some surge because of that capital put into the markets. Now, I have some other charts I want to show you that will drive home a little bit clear how significant that is. It's important also to understand that where we stand with regards to rates, guys, because when COVID hit, they were already cutting rates. The writing was on the wall that the economy wasn't that healthy. COVID hits, boom, they ripped this down to 25 basis points, or 0 if you want to be the mathematician of the group. And all of a sudden, that was the floor set in. So maybe, Bill, you could talk a little bit about the impact of slashing it down to 0 again, right? We should not be, as an economy, stuck at 0. And here we are again, like we were in 2009 to 2015, stuck at 0. Go unmute that mic.
Yeah, exactly. I couldn't get the mic over quick enough. No, there's a lot of similarities there, because if you go back to the 2008 period, as you can see here, the Fed made some very dramatic cuts to get that Fed funds rate down to 0, just like they did in March of this year. But again, in this year, just like they decided in March, in the 40 years that I've been in the bond market, the Fed used the federal funds rate as their primary tool to affect the economy. And just to briefly explain for those who might not know, the Fed funds rate is the rate that banks borrow money from each other. And this is the rate that the Fed sets. When you read in the news, the Fed raised or lowers interest rates, this is the rate they're talking about. And that's a one-day rate of interest. So the Fed brought the rate down to zero, saying to the banks, you can now borrow money for free. But it was deemed then, as it is now, that that's no longer sufficient. Just manipulating the Fed funds rate is not having the impact we want. And that's why Bernanke first, and now Chairman Powell following suit, is getting very aggressive in terms of the tools that the Fed is making available to themselves. This idea that they can just print up money to buy bonds. It's been in academic circles for years, but the US was the first one to really have the courage to do that back in '08. And now I have to point out the rest of the world has followed suit. The rest of the world is also printing up money, but that's a different discussion for an international class. So what we're doing in the US is now being mirrored globally.
So, Bill, let me ask you a question, because right now, Powell just had the meeting yesterday. They've all but announced that they're going to continue to keep this at zero up until potentially 2023. So what's your view on just that announcement and the fact that they're going to continue this out? Usually we saw this after the crash. Now
Right.
We're getting this and we're not technically in the crash yet.
Yeah, and the Fed is really operating with a degree of transparency we've never seen before. I mean, for the Fed to tell us what they expect to be doing for the next 3 years is pretty incredible. We didn't grow up having that. And the Fed is basically, though I have to point out, the Fed has said that because the Fed has also changed the way they operate. They've announced as of this August 27th, back at the Jackson Hole conference, the Fed is not going to be as worried about inflation as they had been. So that basically is the Fed telling the market, look, even if inflation starts ticking up a little bit, we're not going to be concerned. So the market, exactly as you said, Larry, the market is now interpreting that to be the Fed telling us they're going to keep short-term interest rates at zero. But I want to stress, the Fed only controls the short end of the market. So when they talk about keeping interest rates at zero, that's just the Fed funds rate. Other interest rates at longer maturities at different sectors can change, and I think most likely are likely to go up, quite frankly. So when we talk about interest rates, we got to kind of talk about what interest rate are we talking about? The short-term interest rate, zero. The one-day interest rate, zero. That's what the Fed has told us for years. The rest of the curve is really where the question is going to be.
Let me add this question. There's two things coming here. Indigo has a good question. He says, what will be some of the consequences? And this is the big challenge, because we can put on a Keynesian economics hat, an Austrian economics hat, doesn't matter. We're in uncharted territory here with this amount of easing in such a short period of time. If I put on my Keynesian economics or my finance degree, that would tell me with this much money put into our money supply, it is going to devalue the US dollar at an exponential rate, which could lead to an inflationary market. And some of the numbers I saw recently are showing slight increases in inflation. Of course, I am a believer that those numbers and books are cooked. I don't trust inflation information. And I'll give everybody an example. There's a beer out there from Jamaica called Red Stripe. I love Red Stripe. Used to be 12 ounces. Now it's 11.2. Wait a minute. It's the same price, but you stole my beer from me. That's inflation. But the beer in the accounting mechanism that they use on inflation, it's the same price now. So they're not showing any inflation. BS, you took some beer away from me. So these numbers, that's one thing that could happen. The other side of it is hyperinflation, which, we haven't seen it all here as a consequence of this market.
No.
Yep. And honestly, that is what keeps me up at night, because I do believe inflation will ultimately rear its ugly head. But if I could take 30 seconds, because I used this analogy at a class today, inflation is not just measured by the amount of money that's out there. It's really measured by the velocity of that money. How is it turning over? And if I could quickly equate it to maybe people don't understand, I don't know where you are, but where I live, we're having a coin shortage. You go to a store, they announce there's a coin shortage. Would you pay exact? Realize there's no less coins in our population today. I mean, coins haven't been destroyed in the last 6 months, so where'd all the coins go? Well, the point is the coins are out there, but they're not being circulated, right? Because if we're just keeping all our coins in our dresser top drawer or in our wallet, that money is not getting into circulation. Because think about it, if I go to the store today and give them a coin, they put it in the till, they give it to the next customer, the customer takes it to the next store, and so on and so on and so on. And those coins get distributed. But now with everyone holding their coins and them not really being used, we now have a coin shortage. Money works exactly the same way. That's what inflation is all about. yeah, we got a lot of money out there. We got $7 trillion more money than we had before the crisis is. And yet there's no inflation because there's no velocity to that money.
You know what? I got to throw on the conspiracy hat, Bill. My conspiracy hat tells me. My conspiracy hat tells me that coin shortage thing is another BS thing. Basically, the coin shortage is a way for us to no longer use fiat currency, so they can now have all digital currency. But we'll save that for another fall webinar series.
All right,
Merlin, actually, it's all in the wishing wells around the world right now. They just haven't gotten around to cleaning it up.
Right.
Wishing that 2020 would end, right?
Right.
Pretty much.
Larry, do me a favor. You and I talked earlier today about comparisons. You know, one of the things we love as traders or investors is to use history, because they say history is such a great indicator or teacher about the future. We have not, this isn't a one-off event. We have not, this isn't the first time we've seen an economy falter like ours or have some bad economic data or government intervention. And you have some nice slides talking about the 1920s and comparing that to the 1910s. You want to walk us through that one?
Yeah, absolutely. I mean, where this kind of started for me was I started to get really curious about kind of generational cycles. And if we're looking at just what's happening in the times right now, it kind of reminded me of 1968. Like I'm feeling like we're watching the torch pass from the baby boomers to the millennials, the same way the great generation passes the baby boomers. So we went back and we did kind of some similarity comparisons between the 1920s and the 2010s. And interesting enough, when I went in and researched, there was this article talking about it. So the very first point here is that both decades, as you can see, were periods of intense cultural wars. Now, back in the 20s, the two sides were called modernists and traditionalists. Today, they're actually the same thing. The only difference here is that the modernists are known as the progressives and the traditionalists are known as the conservatives. But the debates and conflicts are really the same. They haven't changed. I'll give you an example, okay? In the 1920s, the big science piece was the rage over Darwin's theory of evolution. Today, it's climate change. So there's always a scientific issue. When we talk about conflict over, you love this one, Merlin, mind-altering substances. In the 1920s, it was all about alcohol and the prohibition. Today, it's marijuana, right? That's the new big thing here. Both decades struggled with race relations. Both decades were marked by high immigration. And both decades were really seen as the empowerment of women. I mean, so it's pretty interesting how this comparison started. And all these things that were playing out in the 20s were playing out today. Now, when we go to the second one, both decades began with major economic downturns. So we had the Great Recession in 2008, 2009, but in the 1920s, it also began with a devastating economic downturn as well. In fact, the GNP, the gross national product, plummeted pretty much in 1921 by 24%, compared to the Great Recession, which was only about 4.3%. And the industrial production in the 20s fell by 31%, and the Great Recession declined by about 17%. So we're calling it the recession because it wasn't as deep, but right now I'm going to share some interesting stats and charts. We go to the third point here. Both are really decades marked by economic growth and prosperity. So if we want to just go ahead and if you could just change the next slide, take a look at this. So unemployment in between 22 and 29 was about 3.3%. And that really shot up to as high as by 1933, there was 25% unemployment. Well, following the Great Recession in October of 2009, we were at 9.4%. Now we're kind of back down to about 4%. So if you go back one more time, you can see in 1920, it was also innovation. Back then, 35% of homes had electricity. That was the big thing, indoor plumbing, washing machines, automobiles. So in the 20s, just like we're seeing in the turn of our century with computers and technology changing, these things happen literally over years where we're seeing things happen in minutes. And so as we can take a look at this chart, the total wealth of people almost doubled in the 1920s, and the GDP rose to about 70%. So you had a booming stock market going into the end of the 20s, and it enjoyed 20% of annualized gains from pretty much 21 to 29. And it was considered the marvelous bull run of the Dow Jones Industrial Average. That's what we're kind of taking a look at right now. And so you're looking at this big run up here on this chart. That was the Dow. Now, when we go to number 4, check this out. We also had similar interest rate patterns. So if we can go to the next chart, what we'll see here is that the Fed, and kind of talking what you did, Bill, the Fed was a little different in the 20s because they were still under the gold standard. Remember, Nixon took us off the gold standard. So there was similarity to the Fed rates, or the Fed fund rates, but at the time it was called the New York Fed discount rate, right? And all short-term loans were pretty much the Federal Reserve, not all overnight loans, but the short-term loans were being handled out of the New York Fed. And so if you look at the purple line here, I don't know, Merle, if you want to try a little animation for us, the purple line, the New York Fed discount rate stepped up in 1919 from 4% to, ready, a staggering 7%. And it was basically the effort of centralized bankers to kind of rein in the post-war inflation from the First World War. And it reminds us of the 4.25% hike in the Fed funds that were carried out just before the Great Recession. So again, right before these crashes, the Fed were doing exactly what Bill was talking about. And after the recession of 21, there was a quick recession. The discount rate went back to about 4%, and it stayed there for the majority of the 10 years of the 20s decade. And so near the end of the decade, just like our own here, the Fed crept up, mainly in rate backed up into taming a raging market, which, as Bill will tell you, that's how they try to control these markets, by pumping up these different things. And by the end of the decade, it went up to as high as 6%. And as a result, because they did too much too soon, it basically pricked the inflation bubble market. And that's what we're seeing. So when we go to number 5, both decades witnessed a rise in installment plan purchases. This was interesting, right? Because if you go to number 5, Merlin, you want us to keep forwarding. Okay, flipping to the next slide, what we're going to see here, okay, same thing happened. We saw consumer credit go out of control since the Great Recession. So like we're seeing all the spending right now, they had back in the 20s, they had consumer debt, but it was frowned upon. I mean, you pretty much had buy now, pay later. And when the credit card era started in the 70s, right now, everything is on installment, buy now, pay later. And we're starting to see that these lower interest rates are actually now crushing the poor and the middle class right now. Why? Because it's forcing them to not be able to save anymore and instead go ahead and start purchasing all these durable goods on installment plans. So we're seeing the credit creeping up, and you can see here by 2018, that's a pretty heavy duty, 48% climb from 2008. And so the personal savings rate, really we saw here, as you can see, in the 1920s, just to give you some comparison, the personal savings rate fell from 12.9% in 1920 to 4.1% in 1930. And so as we're seeing here, we started to see same thing happening now. If you go down to the next slide, Merlin, we're going to see the same thing. Increased amount of spending during the decade was channeled through this installment buying. And so we're starting to see personal savings rates going lower and lower and lower again. And so people aren't saving, they're spending. And so the next big topic here is looking at number 6, which was in both decades, you had a large portion of total debt growth, but it was corporate debt. If we go to the next slide, you'll be able to see that that top line of private debt really expanded rapidly over the course of the decade, and it was run up through a lot of private credit, as you can see here in this chart. And so what we can see here, if we want to go on and take a look right now, if you want to just fast forward, you can see in the next chart here, going on one more, okay, we can now see in both decades the Fed balance sheet shrank by the end of the decade before it exploded again. And so what we're seeing now is the Fed Treasury was basically holding a pittance compared to what they're doing now, which Billy just talked about. In 1927, the peak was $700 million. So what I'm taking from all of this, guys, is that in this day and age, in 2010s, the Federal Treasury assets are well in excess of 10% of the GDP. If you include mortgage-backed securities, it exceeded 20%. And so we've got to look at this and say, okay, by the time of the second half of 1928, Most of that damage was already done. Credit expanded, spiraled out of control, kind of similar to what's happening today. And much of the focus tended to be placed on margin to debt GDP, and it hit 8.14 in 1929. So what is this all kind of telling us? Well, if we want to take a look at these experiences of the Great Depression versus the Great Recession, it all stemmed from a lot of deleveraging, which is basically going to create pain, forcing this to occur. And so the economy and the markets eventually are going to trend in one of two paths. And what we have to look at right now, and hopefully people are preparing for this, if that monetary policy continues to keep being very accommodative, meaning that they keep appeasing us to try to keep these things low, and that debt level remains very, very high, and then all of a sudden they cease to help out people, it's going to be very, very painful for us to deleverage this. It's going to be in housing, corporations, municipalities, they're all going to start to unfold, and we know where this could potentially lead. So I'm looking at this saying what concerns me, and love to get your guys' opinion. One, the balance sheet is tons worse than it was in the 20s. Our Fed balance sheet is horrific. We have no idea that if all of a sudden something were to happen like it did in the end of the 20s, what would our market look like? Now, we can't make any predictions. It can keep going higher or it can go lower. But as Bill was mentioning right now, again, we're in unprecedented times. So I just wanted to give a little bit of a history lesson to go that, we can do what we want to do to kind of look at both sides. But, at the end of the 2010s and the roaring, everybody was making money. We had a little blip in '08. But right now, coming into what's coming in now into the 20s again, I just feel like we're a decade behind. 90-year cycle is starting to happen. Love to get your guys' opinion on that.
I love it, Larry. There's a lot of great stuff in there. I'm going to actually circle back to a couple of two different points. One that I found interesting there, and I think all of us would agree that we're in that situation now, is we're trying to find alpha. We're trying to seek alpha, which is beat the markets or find some rate of return on our money. And what they've done is, by having interest rates so low, our savings accounts, if you have money in a savings account, why bother? Just put it on your pillow. It's probably safer. You're not making any money. So they're literally punishing savers. If you look at Japan, they've got a negative 0.1 Fed funds rate, which means that savers, if you keep your money in a bank account, you're literally losing money. So you have inflationary pressures, plus you have losing money by keeping your money somewhere. To me, that is a huge problem here. You're punishing savers. And again, the goal here is, what they want you to do is to spend. They want you to put your money in the market. They want you to go out there and buy stuff. So to me, that's a problem. I think what it does is it kind of flies in the face with what we teach at Online Trading Academy, which is, let's understand what our budget is. Let's understand how much money we have. Let's learn to grow our capital. But certainly, I don't want to park my money in investments or in markets or an account where I'm going to make nothing on it. Let's be more prudent than that. That's a big one for me about right now.
Right. And when things adjust right now, like they've been doing, let's face it, when the market goes down, it's important to remember, when the market goes down like it has in the last couple of days, so is your 401k, your IRA, any one of your retirement savings, So this has got to be something that people need to have a plan for. And you can't just say, oh, I'll figure it out as it happens. That's going to be way too late. Bill, I'm really interested to hear what you got to say, because you really study this.
I have to get a life. I find this stuff way too interesting. My concern is, and I agree with everything we've been saying, but I do want to add a continued cautionary note, because what we're talking about here now is this Fed that's just dumping money into the economy, and the money has to go somewhere. And when we show you that first chart of correlating the Fed to the S&P, I personally have come to despise and hate the word bubble, because in the financial press, anything's a bubble. Anything goes up for 2 days, it's a bubble. But I do think that the actions of the Fed are causing mispricings of assets. Maybe that's a better way to put it. Whether it's the S&P we were talking about, some people feel the recent move in gold is a reaction to what's going on in the Fed, bond market in terms of credit spreads. There's a lot of implications to this that we talk about in a signature series we're offering. But I do think that the implication of this is a cautionary note, because again, when you're unprecedented, that in and of itself should scare us. But when you start seeing the market acting irrationally or in an illogical fashion, that's when doing your homework and taking time is even more important. And that's where I think we are now. I hate to use the word bubble, but I think there are asset bubbles out there that we have to be careful of.
Bill, you and I talked in the past about what you thought was the most I guess, interesting or dangerous or ominous bubble out there. And most people are thinking it's the bond market, the equity market, the housing market. All of those are, potentially in a bubble. We don't know until after the fact. But one thing you pointed out to me a while back was the corporate debt market. And I like this because Larry was talking about one of the correlations we can make between the 1920s and the 2010s is we see a serious increase in corporate debt. And for me, this poses, again, a very big problem because in the 1920s, the Fed wasn't really there to backstop this. We've heard Jerome Powell and his teammates out there, I can't use a specific word, so I'll call them teammates, where he basically said, look, we'll backstop corporate debt. So here's one systemic piece that if corporate bond market starts to fall apart, I think we would all be in agreement that our economy and markets are going to go to hell in a handbasket. It could be very, very ugly. But
and you could make, oh, I'm sorry.
But now you have all of a sudden the Fed saying, hey, we're going to back all this up. So doesn't that remove a huge chunk of potential downside risk?
As long as the Fed stays in there. But we really have kind of a perfect storm of problems arising here. When we talk about just corporate bonds as one example, because with interest rates so low, we've got corporations out there that are borrowing money that don't need it. Apple had $206 billion on their balance sheet when they did their last bond offering, because their logic was, as long as we've got that, as long as interest rates are so low, why not? So corporations are leveraging up their balance sheets incredibly, borrowing money because interest rates are so low. But at the same time, we've got huge credit deterioration going on because the economy is going down. I mean, we've had more corporate downgrades by August of this year than we had in the entire year of 2019. So at the same time, we're bringing more bonds to market, the credit quality of bonds is deteriorating. But as you said, we've now got the Fed in there that's become a big buyer of bonds. I mean, the Fed has authorized themselves to buy $500 billion worth of corporate bonds. That's almost 10% of the market. So if you've got a buyer out there that's going to be buying 10% of the market, that's obviously a positive factor. So we've got these confluences going on. But what happens when the Fed ultimately steps back? What happens when the biggest buyer in the market disappears? That's when, we've got the Fed has kind of got to put on the market right now.
And Bill, if I can add to what you're saying, the other problem you've got is, if you agree, is you now have corporations out there that are borrowing, realizing, oh, no big deal. If I can't make the payments or whatever, it's okay. The Fed will bail us out again. We're too big to fail.
Oh, that's very true.
So when has the government become too big to fail?
Yep. And when did the government get into the business of picking and choosing corporations that are going to survive? That's a whole different discussion, but that's not capitalism as I know it, that's for sure. But that is exactly what's going on. I mean, look what happened at Kodak this year, right? It's a lesson in government intervention and how it can be good or bad. So no, you're absolutely right. The government, through the Fed programs that were instituted in March, is now making loans directly to corporations. They've never done that before this stimulus package.
And before you get out there and everyone starts getting all happy that we're going to have a Fed that backstops the economy, remember, you have things that have been backstopped before that have failed. You can look at the Swiss National Bank when they were pegging to gold. They were backstopping their currency against gold. Everything was fine. And if you trade Forex markets and you see that chart of the Swiss franc USD, it will make you pucker up real quick, because all of a sudden, when they backed away from backing up and supporting that gold or the price of the Swiss franc, it collapsed. Yep. Now, I doubt that the Fed would all of a sudden back away overnight, because somebody would be getting in some pretty big trouble there, but it could happen. It's challenging to put ourselves on that fence of, here we have an entity who has literally unlimited money, who can just back up at their whim whatever they want. And then also the risk of that. And I don't know long-term what the ramifications of that type of backstop will be. My gut tells me it's not going to end well down the road, but to me, it's a kicking the can down the road thing, and we'll have to see how that one all pans out.
Yep, exactly.
For sure.
One thing we should probably address here is the yield curve. This is something we talked about in the past, where we have a normal yield curve, we have a flat yield curve, and you have an inverted yield curve. And an inverted yield curve historically is a very good forecaster for recessions. Of course, last year we had one. So I don't know, Larry, did you want to walk through that yield curve?
Yeah, this was very fascinating because, I like to always look back and forward. Bill and I kind of talk about this all the time. And one thing I want to bring up here, just to kind of define what the yield curve is showing. When we're in an inverted yield curve scenario, what basically is telling us is that I don't have to go longer term to loan my money to some corporation or somebody else, or even the government, because I can be in something much shorter time. So if I'm in a bill or a note, theory, if I'm loaning my money out for longer periods of time, by definition, I would expect to get a higher rate of return on my money for loaning that money. But as we can see here on the chart, the first time I saw this in my kind of realm of trading was in the year 2000. And as you can see on the left, this is the yield curve. And if you look, you can see, and Merlin, if you want to point it out, but you can see that the lower time frame bills and notes were getting a higher rate of return than the 10-year bond. Now, we also can see that this was in the year 2000. We were in the midst of the tech bubble right now. And normally what they would say is, as this starts to happen, they can try to forecast that maybe another, I don't know, 8, 9, 10, 12 months from now, we'd hit a recession. And we can see that we know what happens. Once it's gone into recession, we know what happened in that next year in 2001. In fact, if I can digress for a moment, I was sitting in Omaha, Nebraska at the Berkshire Hathaway meeting, and some guy actually said to Warren Buffett, "Mr. Buffett, you're a smart guy. Why aren't you in any of these tech stocks?" He paused for a moment and said, "My good man, the Dairy Queen Dilly Bar will far outlast any of these tech companies." And sure enough, this was in May of 2000, and boom, you know how that all ended. So he was against it. Now, if we go to the next slide, here's the year. Okay, go ahead, Merlin, let's go to the next slide. And here's the year 2007. Well, we can see here there was a moment where it was higher again. Here we are, right going into the end of 2007, followed by what? The Great Recession and the crash. Well, going forward one more slide if we can, here was 2019, and there was a CNBC discussion about it that really caught my attention. In August 15th of 2019 was the first time that we had seen an inverted yield curve since the Great Recession. Again, look at our chart to the right, all-time highs. So this next chart is going to be very fascinating. I got to give Merlin a lot of credit for building this one. If we want to just go ahead and put it out there and you just want to click forward, what you'll see here is that this is the difference between 1984 and 2008-ish. And if you just kind of click ahead, you're going to see these boxes form. So there we have 3 different boxes up to this point, just around 1990, 2000, and 2007. That's where there was the inverted yield curve. Click one more time, Merlin, and look at these gray boxes. These were either major corrections or crashes. So I want to remind everybody in 2009, if you want to forward one more, Merlin, here's an inverted yield curve. We're starting to get into a recession. I think you both would agree. Now it's being manipulated a bit, but we are in a recession right now, which means could this lead historically like it has before into another correction or major crash? Do we know that? Can we predict it? No, but I definitely want to be planning for something because as they say, those who tend to ignore history, you guys can finish that sentence. So I just wanted to bring that up there, that the inverted yield curve is very important when it comes out because, again, if I'm an investor and I want to give my money for longer periods of time or they want me to, and I'm not making a rate of return that's really favorable for my goals, there's no reason for me to go that long out in time, especially when I can go 3 months to 2 years and get a higher rate of return.
And if I could just build on that, the validity of this is real strong because in the history of the US, we've had 8 inverted yield curves in the entire 240-year history. And truthfully, I'm enough of a dinosaur, I've experienced 5 of them. But within that, of those 8 inverted yield curves, yeah, right. I earned these white hairs.
Did Charles Dow teach you that?
Yes, exactly. His father. But of the 8 inverted yield curves, that is predicting a recession, exactly as Larry says. And it's been 100% correct. We've had 8 inverted yield curves that did lead to 8 recessions within 14 months. So the correlation between these different asset categories is just fascinating. It really is.
Yeah, and by the way, Larry misspoke there. That the last inverted yield curve that we have, guys, was not 2009. It's 2019.
So thank you. 2019.
That's so important is, here we are. We're actually 12 months after the last inverted yield curve, and we might, it's not saying that we're out of the woods yet. Some would argue that the crash happened in February and March was the recession piece. I disagree. I think we'll probably see something else a little bit more brutal down the road, but we'll have to look at some of the economic data. I'm going to do a little trivia question here for everybody. We got 100 and something people in the room. Let's get this chat box moving. I want you guys to answer this trivia question. The winner gets an attaboy. I would like to give you something better, but you just get an attaboy. In 2019, what was the GDP of the United States of America? Good question, right? Most of you live here. You should know what we produce as a country, right? It's one of the most fundamental measures of our economy and any economy around the world, really, which makes us one of the biggest economies in the world is our GDP. So I'm going to give you guys a couple seconds to type into chat what you think our annual GDP is over the course of an entire year. How much do we produce of stuff, right? We should be pretty big producers. Of course, China is going to be big in the production side too, but we're Americans, right? This is going to be a big number. I would love to see, I'm not seeing any, I was expecting this to be flying by in the chat. You guys got it on autopilot, I guess. Do you guys have any clue? Larry, Bill, what's the US GDP in 2019?
I don't get an attaboy.
No attaboys?
I got the chart from a class earlier today. I can't wait till you give them last quarter's GDP number. I'm waiting for the build-up, so I'll let you take it, Merlin.
Daryl Kimbrough, you went out to Google and you searched that, my friend. I know you nailed it to the billion. I was going to say to the penny, but let's be ridiculous here. It's $21.43 trillion worth of GDP. And why is that important? It's important because if we look at what keeps our economy going forward, and of course today's discussion is, what's happening with our economy. Joseph's got a little eager. He said 350 trillion. That's a pretty big economy.
Next month, the way the Fed's going.
Right. Yeah. That's how much money the Fed's printed, right? Our economy is only doing 21.43. If you look at what the Fed has done, and we already looked at the balance sheet where the Fed has increased their balance sheet by about $3.4 trillion in 8 months. Here's a chart of the government debt. Government debt has spiked since COVID started. You can see on the screen here pretty clear and easy that it was right around $23 trillion worth of debt. And all of a sudden, in just a couple of months, we find ourselves very close to $27 trillion. So we're almost putting on, well, call it three. Let's see, we'll call it $3 trillion. So if you take that $3.4 trillion that the Fed has injected into the market, another $3 trillion that the government has put into the market, that's a total of $6.5 trillion. And I'm sure we have much, much more behind the scenes there. The reason I bring this up is interesting for me because all of our jobs, right? Me creating education and content at OTA or doing my own shows or selling products on eBay, that's all like GDP stuff, right? It's product, it's services. What's weird about this is if we do $21.43 trillion worth of GDP in 1 year, you have to look at the government and the Fed have put in by themselves without us doing anything nearly $7 trillion in the market. That's 33% of our GDP is already done by those two entities without us having to lift a finger. This could completely augment any data going forward and make it look just really strange. Of course, when we look at some of the data, they need to be doing some stimulus, but it begs the question, is it too much? Have they gone a little bit overboard? And, personally, I think a lot of this money that was intended to go to people who really need it ended up in the pockets of people who just don't need it, are just taking advantage of a free cash helicopter, if you will, from Powell and his team. So I wanted to show you that chart because I thought that was a good one to show with regards to government debt. Let me go through and show you here a little bit of economic data, and then we'll maybe do some open Q&A. Most of you probably haven't seen this chart. This is what we see out in California all the time.
Seismograph.
It's what?
It's a seismograph. It's an earthquake.
I can name that too. I could probably name that earthquake right there. Oh, that's the Loma Prieta right there. No, this is a seismograph which measures earthquakes. And the reason I thought it'd be interesting for us to see and start with this picture is this is exactly what our economic data looks like. What it normally looks like is the very left-hand side of your chart. I'll even do some crude drawing with my red pen here. I know you guys have probably been laughing at my art skills, but this is what the market data normally looks like, right? Little waves back and forth. Then all of a sudden we get this point here where it gets real jagged. This in the middle is what COVID has done to our market and our data. And I'll show you some here just to drive home that point. I just mentioned that we do $21.43 trillion worth of GDP in 2019. Here is GDP for 2000 right now. As of right now, we're looking, and this is percentage. We are seeing right now a 31.7% contraction. I don't know if that is scary to anybody out there, but a 31.7% decline in GDP. Talk about things grinding to a halt. And you might remember the financial crisis of 2007 and 8. And you're like, gosh, it was so bad. That was one of the worst periods of the market ever. Really? Look at this chart. This red circle I'm drawing, or oval, or whatever you want to call that little thing I'm drawing it over and over again. That's 2008. That's no big deal. I mean, we got to just below -5%. So this should really speak volumes about what's happening right now. We're down here at this -31% contraction. That said, we will bounce back at some point. If anything, America is one of the most resilient countries in the world, but this is going to have a significant impact on our markets and our economy going forward. Now, to show the seismograph in a better representation, we are, and everybody in the world knows this, we are a consumption economy. One thing Americans do very well, we buy stuff. I mean, we line up and beat people over the head with sticks just to get into Walmart on Thanksgiving morning so I can get a TV for $5. It's ridiculous how we spend. Anyway, my soapbox is getting smaller and smaller.
Sorry about that, by the way, Merlin. Didn't mean to hurt you there.
Yeah, it's okay. The welts have gone away, but I love my new TV that has a crack in it. All right. Here's your retail sales numbers. And you'll notice that for the most part, guys, this is from 2012 all the way through today. It's pretty much stayed in this tight little range, right around zero. Obviously, we'd like to see it above zero, showing some growth in retail sales. But what we saw in February and March was jaw-dropping. I've never seen declines like that in retail sales in my life. And, this was just the shot across the bow. And this is why you saw the Fed and our governments just unload money into the markets to help prevent this from getting worse. Well, look at the swing we had from March to June. We went from like -17 to up over 17 positive. That's a 34% swing. Ridiculous swing. Now, in the true essence of that seismograph, what should happen right now? We get the big swing down, we get the big swing up, and then we get another swing down. The question is, how low does it go? My guess is we will probably see it drift down a little bit in a negative territory, but given the amount of stimulus, I just don't see it getting back down to -15%. And keep in mind, folks, we are going into the holiday season, right? Thanksgiving, Black Friday is just around the corner. You got the Christmas holiday. So we should see some stability. And Big Ed says like a rubber band. Exactly. But it's also like a pendulum. If I really whip that pendulum to one side, it's going to have a dramatic impact the other way until finally it starts to get back to normal, like that seismograph picture did. Let's show you one more, which I think is very interesting. Many of us have been in this boat of unemployment. This chart shows you from 2012 through today, or the most recent unemployment numbers. And I think it's interesting because if you look at the hard left side of the chart, gradual decline, slowly drifting down, the Fed doing what it could to get back to what they call full employment. We were down around that 3.5% mark, looking great. And all of a sudden, in 2 months, we jumped up to over 14% unemployment. That is an unbelievable spike in the unemployment numbers. Now, the good news is it's slowly drifting back down. Current number is 8.4%. That came out just a week or two ago. But my guess is we will go back and revert back to a normal number, but probably not that 3.5%. My guess is we'll bottom out somewhere around 5 or 6%. The reason being, a lot of these businesses, because of COVID, have been shut down. I think I read somewhere that Yelp said that 60% of the businesses that closed for COVID are permanently closed and no longer in business. And that's obviously going to have an impact. You also may be in that group that knows people who make more money on unemployment now than they did actually working, right? Because of the stimulus that the government was giving. So they're kind of incentivizing people to stay on unemployment. Hopefully that goes away and we can get things back open and get the economy roaring here again soon. So
hey, Merlin, I guess if one thing, if you can bring back 2 slides real quickly, I want to point something out because it's important. One more. If we get this next quarter, it's going to end in about 13 days and we end up in negative GDP for this next quarter, it's officially what they would call a recession.
Right.
So we are basically about 2 weeks away from everybody labeling it officially a recession.
And I agree. I don't think there's a doubt in anybody's mind that we're going to get a negative GDP, a quarter GDP, even with the stimulus that's out there. So, we can technically say that inverted yield curve we saw back last year is now all of a sudden come to fruition. The challenge here, guys, and maybe we can offer our thoughts on where these markets may be headed in kind of our 30,000 foot view. I'll start off by saying, given the amount of stimulus that the government, the Fed has put in, it's hard not to have a bullish bias. Unfortunately, this is not a 2-piece puzzle. There are thousands of pieces here, and a lot of it is showing actually negative information. I see a comment out here that Susan S. says, great money-making opportunity. This is some of the best money-making opportunities I've ever experienced. Although if you're not prepared, if you don't have money management or risk management, stop losses, it's the most dangerous environment you could be in, right? A lot of you probably were losing your minds back in March as your 401k just evaporated. You're happy now, but let's be more proactive about it. So I'm cautiously optimistic that we'll get back because of what's happened with COVID. I think that chart I showed at the very beginning shows COVID slowly becoming less and less of a factor. The death rates aren't as astounding as they made it sound like in December and January. So I think we'll slowly get better there. That might boost the economy. And I think after the election, we'll probably start to see a robust market, depending on who's elected, but you'll wait for a Larry and Merlin election show on that one.
Well, if I could add to that, Merlin, I would also say be careful, because if we do get some form of a correction again, don't just start jumping out and buying anything. You got to be very careful, because in 2008, people had these what they perceived to be bargain basement opportunities. But let's face it, you bought GE, you didn't make much money since 2008. So you really got to understand that even though things get cheaper, I want you to remember, it may be that it's now actually valued of where it should be that low, not an opportunity, but it finally got the hype out of it. And you all remember that when you bought Cisco at 90 back in the year 2000, right?
Cisco's on my list, Larry. I can never trade Cisco again. Bill, what's your take on it? Because you're not as active of a trader as I may be. I know that you like to look at kind of the macro bond pictures, which is something that most of our viewers, and I'm going to speak for most people, aren't really focused on that bond market, but you have that pulse down. What's your hypothesis going forward?
And my hypothesis very strongly is that we're going to go into higher interest rate environment. That's the next phase. And the reason is simple supply and demand, which the OTA community is comfortable with. I mean, you mentioned about that $3.3 trillion deficit, right? Our fiscal year ends in 2 weeks, which, by the way, we're going to close down the government if Washington doesn't do something in the next 2 weeks.
Right.
But the budget ends at the end of the month, and we're going to have a $3.3 trillion deficit. That means the government is going to have to issue $3.3 trillion more worth of bonds to finance that deficit. I mean, we've got a huge supply of bonds coming into the market, and it started 2 weeks ago with the Treasury auctions that are now hitting record sizes. So it's supply and demand 101. If you have all of these bonds coming in to finance the deficit and assume demand is a constant, that means prices are going down and yields are going up. Right. So if you think about it, a higher interest rate environment, sure, it affects the bond market, but it also affects commodity prices. It affects currency markets. I mean, I'm a bond guy, so I think the whole world revolves around interest rates and bonds. I got to learn it doesn't. But there's such a correlation that if we have a higher interest rate environment, there's going to be impact all across the board. And you notice I'm avoiding the equity market in terms of giving a focus because I'm not an equity guy. I'm just not. Mm-hmm. I kind of honestly look at the equity market, and if you look at this slide with a negative GDP of 31.7%, I don't understand why the equity market is hitting all-time record highs at that same time. So I will admit my confusion there. I'll stick with bonds, which I know much better, and interest rates, which I know.
And I think rules are changing, Bill. I think right now we have always believed that when the stock market goes down, we should put our money in gold or into the yen or into bonds, but they're all high. And so at this point, it makes it very confusing. Where do you put your money now based upon what the market might do? And I think we're going to see unprecedented change, and we've got to know how to manipulate, or not manipulate, but more kind of manage these markets right now.
Absolutely. As we're seeing, volatility is critical in this market. We're seeing more and more. We have to manage that and use that as the opportunity it is. I mean, as traders, we want volatility. From the trading point of view, the worst thing is the quiet market. It's just a matter of managing it properly.
I'll wrap it up here real quick. By the way, Bill, Larry, thank you guys for coming on. I do appreciate setting some, like high-level viewpoints on these 5 topics or 4 topics today with regards to economy. So thank you so much for joining today. I appreciate that.
Thank you, Merlin.
Pleasure. Appreciate it.
For those that might not know, Tony Nessa says, true, I hate stocks. I love stocks. If you can make money in it, I love it. This is kind of the first of the fall webinar series. So we'll be doing many more of these. I'm going to read you a list of what's going on here. I don't have the dates out, but you guys will be notified about them soon. Jordan Matthews and Brock Pierce are going to be doing a session on hot stocks, which should be very interesting. Todd Davis, who you guys all know and love from OTA, will be doing a GPS session as well. One of the personal favorites that I'm going to be hosting, that's why it's my personal favorite, is war stories from the floor. I'm actually talking to some real Chicago floor traders. We'll have Bob Dunn and Bill Henner in a panel discussion talking about what some of the things they experience in the markets. That's going to be a great one, especially for those of you who start off as retail traders, have never been on a floor. Gosh, the stories from there are great. It's like talking to a cowboy about the wild, wild west. It's awesome. We'll also talk about click updates with Mark Greco and Todd Davis. And finally, an election preview with Larry Jacobson and myself. I'm going to dress in one party, he'll dress in the other, and we're basically just going to stand in front of each other and insult each other for an entire 45 minutes, as basically the debates are going to be about. Anyway, just kidding. We'll look at some areas of investment opportunity and what typically happens versus Democrats and Republicans with the markets after an election. And I saw a comment that came through here earlier that was talking about how volatile the election was going to be. It's going to be very bad. And I don't mean that it's just going to crash or it's going to soar. It's just there's going to be so much uncertainty in that election market and election cycle that it creates great opportunities. So basically, as traders, as investors, manage your stops, make sure you don't get whipsawed and knocked out of these markets. So tons of opportunity out there. All right, everybody, that will do it for today's presentation of our fall webinar series. Thank you so much for joining us. We hope to see you on our next one. We'll see you soon. Take care.